The United States government currently owes $35 trillion. That's trillion with a T. Every second, the national debt increases by approximately $80,000. By the time you finish watching this video, it will have grown by several million dollars. But here's what should disturb you. The government now pays over $1 trillion annually, just in interest on that debt. That's more than the entire defense budget, more than Medicare, more than anything except Social Security. $1 trillion every single year flowing out of the Treasury to bondholders who will never receive the principal back because the principal will never be repaid. And yet, despite this, the government continues borrowing, not reluctantly, aggressively. In 2020 alone, the US created nearly $4 trillion out of thin air. Congress keeps raising the debt ceiling. Executive orders continue expanding credit facilities and emergency lending programs. The borrowing accelerates year after year, administration after administration, regardless of which party controls power. This should raise an obvious question. If the debt is catastrophic, if it's unsustainable, if it threatens the future of the nation, why does the government keep making it bigger? Why does Wall Street celebrate when Treasury auctions succeed? Why do financial markets panic when government borrowing slows? The answer is simple, and once you see it, you'll understand why $35 trillion isn't a crisis to be solved. It's a business model. The United States government has transformed debt from a temporary financing tool into the most profitable industry on earth. And the people who profit from it, they're not hoping for the debt to shrink. They're hoping it grows forever. Let me show you exactly how the system works, who benefits, and why the debt can never be paid off without collapsing everything. Start with the most basic question. When the US government pays $1 trillion in annual interest, where does that money go? The answer is documented. It's public record. About $8 trillion of UAE's debt is held by foreign governments, China, Japan, the UK, and others. They buy treasury bonds as a safe place to park reserves. When they collect interest, that money flows out of American taxpayers' pockets to foreign central banks. But the bigger story is domestic. About $27 trillion in US government debt is owned by American institutions. The Federal Reserve holds roughly $5 trillion. Social Security and other government trust funds hold about $7 trillion. Private sector institutions, pension funds, mutual funds, insurance companies, and banks hold the rest. And then there are the asset managers. BlackRock, Vanguard, and State Street collectively manage over $20 trillion in assets. A significant portion of those assets are U.S. Treasury bonds. These firms don't own the bonds directly. They manage them on behalf of pension funds, retirement accounts, endowments, and insurance pools. But they control the allocation. They decide where the money goes. And treasury bonds are the foundation of their portfolios because they are considered the safest investment in the world. Here's why that matters. When the government pays interest on its debt, that money flows to these institutions. Every quarter, billions of dollars move from the U.S. Treasury, funded by taxpayers, to bondholders. For large asset managers, this is automatic revenue, predictable, guaranteed, backed by the full faith and credit of the U.S. government. And here's the key. The more debt the government issues, the more bonds exist. The more bonds exist, the more interest payments flow. For institutions that hold treasury debt, government borrowing isn't a crisis, it's inventory. More debt means more assets to manage, more interest to collect, more fees to charge. This is the first piece of the puzzle. Debt isn't just an obligation, it's an asset class. And for the financial sector, it's the most profitable asset class in existence because the government guarantees payment, the market is liquid, and the supply keeps growing. It wasn't always this way. For most of American history, debt was temporary. The government borrowed during wars, then paid it down during peacetime. After the Revolutionary War, Alexander Hamilton restructured the debt and established a system for repayment. After the Civil War, the government ran surpluses for decades to reduce borrowing. Even after World War I, the debt was paid down. But something changed after World War II. The U.S. emerged as the dominant economic power. The dollar became the global reserve currency, and instead of paying down wartime debt, the government discovered something remarkable. It didn't have to. By the 1970s, deficits became normal. Politicians realized they could spend more than they collected in taxes and simply borrow the difference. Voters liked government programs. They didn't like paying for them, so politicians delivered services, borrowed to cover the cost, and kicked the bill down the road. But this should have hit a limit. At some point, lenders should have refused to keep lending or demanded higher interest rates or insisted on repayment terms. That's how it works for individuals. That's how it works for corporations. Why didn't it work that way for the government? Because the US government isn't an individual or a corporation. It has a structural advantage. It can tax, and more importantly, it controls the currency. The Federal Reserve, which is technically independent but functionally integrated with the Treasury, can create dollars at will. This means the government can always pay interest on its debt because it can always create the money to do so. This changes the entire dynamic. A corporation that borrows too much goes bankrupt. A household that borrows too much loses its house. But a government that controls its currency and can tax its citizens will never default. Not technically, because it can always print money to make interest payments. So debt became permanent. Not because politicians planned it that way, but because the structure allowed it. And once Wall Street realized the government would never default, treasury bonds became the safest investment in the world. Safer than corporate bonds, safer than real estate, safer than gold. Because the US government, unlike any other borrower, could guarantee payment forever. The transformation accelerated in 2008. The financial crisis hit, banks were failing. Credit markets froze, the economy was on the edge of collapse, and the Federal Reserve made a decision that changed everything. Instead of letting markets clear, instead of allowing insolvent banks to fail, the Fed intervened with a program called quantitative easing. The mechanics were simple but revolutionary. The Federal Reserve created new dollars and used them to buy treasury bonds and mortgage-backed securities from banks. Let me repeat that. The Federal Reserve created money, trillions of dollars, and purchased government debt. This wasn't borrowing from China or from pension funds. This was the central bank manufacturing currency and buying bonds that the Treasury had issued. This should sound insane. The government issues debt. The central bank prints money to buy it. The government spends the money, and the debt sits on the Fed's balance sheet, theoretically backed by future taxpayers, but functionally backed by nothing except confidence in the system. Before 2008, the Fed's balance sheet was under $900 billion. By 2015, it was $4.5 trillion. And then came 2020. When COVID hit, the government needed to spend massively. Stimulus checks, unemployment benefits, business loans, hospital funding. Congress authorized trillions in emergency spending. But the Treasury didn't have trillions lying around, so it borrowed. The Federal Reserve stepped in again. It created roughly $3 trillion in new dollars and bought Treasury bonds. By the end of 2020, the Fed's balance sheet had ballooned to over $7 trillion. This was the largest monetary expansion in American history. Trillions of dollars created out of thin air to purchase government debt. And here's what nobody explains. That money didn't disappear. It entered the financial system. Banks suddenly had massive reserves. Asset managers had more capital to deploy. Markets surged because there was more money chasing the same assets. The government debt increased, yes, but the financial sector got flooded with liquidity. For Wall Street, this wasn't a crisis, it was a windfall. More government borrowing meant more bonds to buy. More bonds meant more interest payments. More money in the system meant higher asset prices. Everyone holding financial assets got richer. This is the mechanism. Debt creation is money creation. When the government borrows and the Fed buys the bonds, new dollars appear. Those dollars flow into the financial system, inflating asset prices, enriching bondholders, and ensuring there's always demand for more. Government debt, now scale this forward, the US government spends roughly $6.5 trillion annually. It collects about $4.5 trillion in taxes. The deficit, the gap between spending and revenue, is over $2 trillion per year. That gap must be borrowed. Every year, the Treasury issues new bonds to cover the deficit, plus it issues bonds to roll over old debt that's maturing. In total, the government borrows several trillion dollars annually just to keep operating. Who buys these bonds? The same institutions. Pension funds need safe assets. Insurance companies need predictable returns. Foreign governments need dollar-denominated reserves. And the Federal Reserve stands ready to buy if demand weakens. This creates a feedback loop. The government borrows, bonds are issued, institutions buy them, interest is paid from taxes, and the debt grows. Next year, the deficit is larger because interest payments are higher. So more bonds are issued, more interest is paid, the cycle repeats. But here's the critical insight. The system requires the cycle to continue if the government suddenly stopped borrowing, if Congress balanced the budget and the Treasury stopped issuing new bonds. The consequences would be catastrophic, not for the government, for the financial system. Treasury bonds are the collateral for the entire financial market. Banks use them as reserves. Hedge funds use them in repurchase agreements. Pension funds hold them as their safest assets. If new treasuries stopped being issued, there wouldn't be enough safe collateral to support the $100 trillion global financial system. Liquidity would collapse, credit markets would freeze, asset prices would crash, not because the economy failed, but because the financial system depends on continuous government borrowing to function. This is why the debt ceiling fights are theater. This is why the government always raises the limit, because not raising it, not borrowing, would collapse the system. The debt isn't a bug, it's the foundation. Let's make this concrete. The government pays over $1 trillion in annual interest. Who receives it? Foreign governments receive about $200 billion. Social Security and government trust funds receive roughly $300 billion, though this is just the government paying itself, and ultimately taxpayers will have to make good on those IOUs. That leaves about $500 billion flowing to private sector bondholders annually. $500 billion every year paid from taxpayers to institutions that hold government bonds. This includes banks, insurance companies, pension funds, and asset managers. For asset managers like BlackRock, this is business. They manage trillions in assets, a large portion in treasuries. They collect fees on assets under management. The more government debt exists, the more assets they manage, the more interest the government pays, the higher the returns for their clients, and the more attractive their funds become. For banks, treasury bonds are ideal. They're liquid, they pay interest, and they count as high-quality assets for regulatory purposes. The more treasuries the government issues, the more safe assets banks can hold, which allows them to expand lending and leverage. For pension funds, treasuries are necessary. They need low-risk, long-term assets to match their obligations. Government bonds provide that. The more debt issued, the more supply available to meet demand. And for the wealthiest individuals, those who own large stakes in these institutions or hold bonds directly, government debt is a wealth preservation mechanism. They lend to the government, collect interest funded by taxpayers, and their principal is guaranteed because the government will never default. This is the structure. The government borrows, the financial elite hold the bonds, taxpayers fund the interest, and the debt never decreases. It's a transfer system, running continuously, moving wealth from workers and middle-class taxpayers to bondholders and financial institutions. And it's automatic. There's no villain pulling strings. The system operates through incentives. Politicians want to spend without raising taxes. Voters want benefits without paying for them. Financial institutions want safe, profitable assets. Treasury bonds satisfy everyone except the people paying the interest. Here's the final piece. Why can't the government just pay off the debt? Why not balance the budget, run surpluses, and reduce the $35 trillion over time? Because paying off the debt would destroy the money supply. Remember, dollars are created when the government borrows. The Federal Reserve buys bonds with newly created money. That money enters circulation. If the government paid off $35 trillion in debt, $35 trillion in dollars would disappear from the system. The result would be deflationary collapse. The money supply would shrink by more than half. Businesses couldn't get loans. Consumers couldn't spend. Asset prices would crash. The economy would seize. But it's worse than that. Treasury bonds aren't just assets. They're collateral. The entire financial system uses treasuries as the foundation for lending and leverage. Repurchase agreements, which keep short-term credit markets functioning, depend on treasury collateral. If that collateral disappeared, credit markets would freeze instantly. This is why the government will never pay off the debt. Not because politicians are irresponsible, though they often are, but because the structure of the financial system requires continuous government borrowing. Debt is the lubricant that keeps markets moving. Without it, everything stops. And the people who understand this, the executives at major banks, the portfolio managers at asset management firms, the policymakers at the Federal Reserve, they know the debt can't be repaid. They know it will keep growing, and they're positioned to profit from that growth indefinitely. Look at recent actions. In 2021, the infrastructure bill added hundreds of billions to the debt. In 2022, the Inflation Reduction Act added more. Every year, Congress passes budgets with trillion-dollar-plus deficits, and executive orders continue expanding federal credit programs, guaranteeing more loans, backstopping more markets, ensuring more borrowing. These aren't mistakes, they're features. Every expansion of federal credit creates more debt. Every debt ceiling increase allows more borrowing. Every emergency spending package floods the system with more bonds. And Wall Street cheers. When treasury auctions go well, when demand for bonds is strong, markets rally. Because strong demand for government debt means the system is stable. It means the game continues. It means more interest payments will flow to bondholders. The media frames this as crisis. Politicians call it unsustainable. But watch what they do, not what they say. They keep borrowing, they keep spending, they keep issuing bonds because the system rewards them for it. Politicians get to deliver benefits to voters without raising taxes. Financial institutions get more assets to manage and more interest to collect. The Federal Reserve gets to maintain control over monetary policy through bond purchases. Everyone in power benefits from more debt. The only group that doesn't benefit is the one paying for it. Taxpayers, workers, middle-class families whose wages stagnate while asset prices inflate. They fund the interest payments through taxes and inflation while bondholders collect the returns. Let's return to that $1 trillion in annual interest payments. That money comes from federal revenue, which comes from taxes. Every working American contributes to that payment through income taxes, payroll taxes, and corporate taxes passed down through lower wages and higher prices. $1 trillion per year. That's roughly $3,000 per American annually, just to service debt, not to reduce it, just to pay interest. For a family of four, that's $12,000 per year flowing from their taxes to bondholders. And next year, it'll be higher because the debt is growing. Interest rates have risen from near 0 to over 4%. That means new debt costs more to service. As old low-interest bonds mature and are replaced with new higher-interest bonds, the annual interest bill climbs. By 2030, some estimates suggest interest payments could exceed $1.5 trillion annually. That would be more than the government spends on Social Security, more than defense, Medicare, and everything else except mandatory spending. The largest single line item in the federal budget would be interest payments to bondholders. This is the end game of the system. An ever-growing share of taxpayer money flowing to the financial sector automatically, permanently, with no way to stop it without collapsing the economy. Here's the final truth. The US government has turned debt into an industry, not accidentally, structurally. Every developed nation runs deficits, but the United States is unique because the dollar is the global reserve currency. That means demand for US debt is global. Foreign central banks need dollars for trade. They hold those dollars in treasury bonds. This creates permanent structural demand. As long as the dollar remains the reserve currency, there will always be buyers for US government debt. The Treasury can issue as many bonds as necessary and the market will absorb them. This gives the US government unlimited borrowing capacity, something no other nation has, and the financial sector has built an empire on this. Trillions in assets under management, trillions in derivatives tied to Treasury yields, entire business models predicated on the assumption that US government debt will keep growing, that interest will keep being paid, and that the system will never collapse. This is the industry. Debt creation, bond issuance, interest payments, asset management, all of it running 24/7. Generating wealth for those who control the bonds, extracting value from those who pay the taxes. It's not a conspiracy. It's not secret. The mechanisms are public. The data is available. The Congressional Budget Office publishes debt projections. The Treasury publishes interest payment data. The Federal Reserve publishes its balance sheet. Everything is documented. But it's invisible to most people because it's not framed as what it is. It's not called wealth extraction. It's called debt service. It's not called a transfer system. It's called fiscal policy. The language obscures the reality. But the reality is simple. The US government borrows trillions. Financial institutions hold the debt. Taxpayers fund the interest. The debt never shrinks. The interest never stops. And the system grows larger every year. $35 trillion in debt isn't a national emergency. It's not a crisis. It's not unsustainable in the sense that it will collapse tomorrow. It's the most profitable industry ever created, and it's functioning exactly as designed. The government will never pay off the debt. It can't. Doing so would destroy the money supply, collapse the financial system, and trigger a depression that would make the 1930s look mild. The debt must grow, the system requires it, and the people who benefit, the institutions that hold trillions in treasury bonds, the asset managers who collect fees on government debt, the banks that use treasuries as collateral, they're not worried about $35 trillion. They're counting on 40 trillion, 50 trillion, 100 trillion, because every dollar of debt is an asset on someone's balance sheet. Every interest payment is revenue. And as long as the government can tax and the Federal Reserve can create money, the system perpetuates itself indefinitely. The debt trap isn't a trap for the government. It's a trap for taxpayers. They pay the interest, they bear the cost, and they never see the benefit because the benefit flows upward to bondholders, to financial institutions, to the elite who control the system. This is how power actually works. Not through shadowy meetings or secret conspiracies, through structure, through incentives, through mechanisms built into the system that automatically transfer wealth from the many to the few. 4 decades ago, deficits were considered dangerous. Now they're normal. 2 decades ago, $1 trillion debt ceiling increase was scandalous. Now it's routine. The boundaries keep expanding, the debt keeps growing, and the financial sector keeps profiting. If this changed how you see government debt, if you finally understand that $35 trillion isn't an accident or a mistake, but a system working exactly as designed, then you're starting to see how the machine actually operates. Subscribe if you want to understand who built this system, how it functions, and why it can never be reversed without collapsing everything. Because they're not going to teach you this in economics class. They're going to teach you that debt is temporary borrowing to be repaid. But the architects of the system knew better. Debt isn't temporary, it's permanent. It's not a problem, it's the foundation. And interest isn't a cost to minimize, it's the rent we pay to live in their economy. The machine is running, the debt is growing, and someone, somewhere, is collecting every single payment.